Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, June 14th, 2017. I wanted to do a follow-up to the video, there was a static post with static charts, individual screenshots of the S&P 500, labeled S&P 500 sector analysis, posted back on May 8th. As a lot of you know, if you followed the site for a while, I don't just follow an index or a sector or an ETF. I like to drill down, particularly in those that are made up of some top-heavy components. Not all of those are. IWM, for example, is pretty well balanced. There's not any one or two or three stocks that make up the bulk of it. However, that's not the case. As you guys know, I always talk about what I dub the FANG stocks. Ironically, we had a Goldman analyst come out when the Qs fell hard on Friday. They paraded it out, and he had this great new term he came up with that we should quit focusing on the FANG stocks, F-A-N-G, that Kramer came up with years ago, that it's all about the FAAMG stocks. Anyways, I'll post an article on that later. But as you know, I've been talking about that for a while because those five stocks alone have carried the market. And it's certain sectors or indexes like I think I mentioned the Russell 2000, that's very diversified. There's not many, there's almost 2,000 stocks in there, and there's not any one or two or three that make up the bulk of it. But yet, that's not the case in the S&P 500. Now, let me back up a second. I've said this before. People talk about the stock market all the time. What is a stock market? Well, it's just a compilation of all the stocks that trade publicly that you and I can buy and sell. The S&P 500 comprises of, I believe it's over 80% of the entire market capitalization of the stock market. Given it's only large cap stocks, doesn't have small and mid caps, but with that being said, it encompasses most of the stock market. The QQQ, as I often say, is simply a tech fund with an Amazon kicker. Lacks any financial stocks. Sure, there are some other sectors, but tech by far is the biggest component. And now I'm going to get into this with S&P 500 because that's really the market. And so let's to see where the market's going, we need to know where its components are going. If you lose interest towards the end of this video, as you see here, I'm going to go through. This is just a screenshot from that post back on May 8th, and it lists all the sectors in the S&P 500. So as I go through this, keep in mind, I'll go through them in descending order of weighting, starting with information technology. So just like the Qs have led the stock market up, just as the FANG stocks, the FAAMG, Facebook, Amazon, Microsoft, and Alphabet have led the Qs up in the technology sector, that's also what's led the S&P 500 up. However, there's also a pretty significant weighting in financials, healthcare, as you can see, consumer discretionary. You get down here to utilities, REITs, basic material stocks, that doesn't have so much. So if you lose interest here in the video, just watch at least the first five. But I'd like to go over all of these. They're playing out so far as expected. And I just want to compare to where the market was then, where it is today, and what may happen going forward, most importantly. So this was, again, May 8th. This is what I was looking at XLK. I had a little minor trend line here. And this is the trend line that I was talking about here. This is the trend line. You can see our primary uptrend line that needs to go. So I have a scenario drawn where we come down here, hit that trend line. Oh, there's also horizontal support around 52.55, and then bounce from there. A little reaction possibly, and then a move down to any or possibly all of these targets. It all depends on how ugly it gets. So here's where we were back at that time. So we did get a breakdown. If I put the crosshairs up, you can see right about there. That's that minor uptrend line. We did break down below it, had another thrust. We back tested it from below, and we're starting to roll over. Again, XLK, the technology sector, makes up about 23% of the S&P 500. The weighting's right here. And you can see that massive bearish engulfing candlestick. Those aren't 100% accurate. I'll talk about that maybe later, possibly in another video when we get to QQQ. We had a few bearish engulfing candles in the Qs in recent months. However, none of those were followed up by any downside candles. This one was so far. We had a follow-through downside candle, and that helps to affirm or confirm, I should say, that breakdown in the financial stocks. But until and unless I have a minor uptrend line right here, see this yellow uptrend line? That needs to go. That's where we hammered off support. I since added that trend line. There's a few reactions. So this is the big one. watch for a break of this trend line, a break of Monday's lows. That would certainly be a bearish technical event. And then see how XLK acts if and when we get to this trend line. It's not the most, I don't put a super high weighting on it because we only have 3 reactions, 1, 2, 3. I'd like to see another reaction on it. If we hit it again, maybe a little bounce, then a breakdown, a 4th reaction would really help to validate that as a significant technical level. Negative divergences, everything I like to see, confirming the bearish nature of that divergent high. The divergent high was followed by a big bearish engulfing candle, which so far we haven't even recovered half of that candle yet. Maybe half, I don't know. I'd have to look at a retracement on XLK. And again, this is a pretty big support level here, 52.50 just below. So that's XLK. All right, let's go to the next one up, which would be financials. So here's the financials. And we've had some interesting developments. This is a multi-month trading range that we've been in the financials. I've highlighted it before. I was looking for a downside break, and I still am. Now, this has given me pause. If you've been keeping up in the trading room, you know that I've talked about the recent breakout in XLF, the financials. But I did an extensive coverage in the market wrap. Was it the other night? I put a market wrap video up covering the top 5 components, because when you drill down within XLF, it's an unbalanced, what I call a top-heavy ETF, as is the financial sector. In other words, there's just a few companies, and here they are. So let's just, before I go to the big companies, here's the breakout. Looks convincing. I mean, if I was full-blown bullish on XLF, I would have gone long on this breakout. That, you know, it had everything you like to see. It had a high volume day. You can see the candle, the nice volume confirming the breakout. It was a well-defined, very tight sideways trading range, but look what's happened. No follow-through, very little, and now we're down 1.27%. So had you taken that breakout, by the time you realize, okay, yeah, this is the real deal, volume's confirming, right now you're back to break even. If that fails, and you guys have heard me say this many times, fewer things in trading are more bearish than a failed long side bullish breakout. So if we come back down, especially impulsively down into the within this trading range, we're probably going to go to the bottom and then break to the downside. That's my take. Now, we may want to come in and this may be a simple back test. So if you're bullish and you disagree with my analysis, this is trading 101. This is when you want to step in and buy. You now have your second chance. If you're bullish, buy on a back test, and maybe not even, why even wait for a back test? What are you talking, another, quarter point or whatever on XLF? Start stepping in now, buy down there, and put your stop somewhat below if it fails. Back tests may usually dip through a little bit, so you might want to give yourself a little room. But again, I'm more concerned with, and I'm waiting to see if we have a failed breakout. Now, to my point here, these are the leading financials, and I'll just go through the handful that I went through in that video. Here's Berkshire, and that had a very nice, clean, bullish falling wedge. Nothing to argue, breakout, and that one played out nicely. Berkshire is not a bank, as you guys know. It's a holding company. They hold a lot of different companies, similar, if you will, in theory to what a mutual fund or a hedge fund is. However, here's your big banks. JPMorgan, the largest bank in the U.S., there was a trend line right there, a breakout, which looked convincing, somewhat convincing. I shouldn't say that, lackluster. And so far, that's failing. Now, let's see if we follow through. We're at an important juncture. It's down 1.43% as I do this video. If we move back down below that trend line, this is a descending price channel, this down trend line and this trend line. So if we fall back into the channel, that's a failed breakout. Again, a very bearish technical event. MACD is still in bearish, or the PPO down here is still well in bearish territory. What I mean by that, if you're new to the site, there's nothing perfect as far as trend indicators go, but when you look at the signal line, the 9 EMA, the white line, which is the second attitude across, when that's below 0, as you can see, the trend is bearish. When it's above 0, as you can see here, the trend is bullish. A little bearish, nice little correction there. Told you to stay long all the way here. Told you at this point. That's a pretty effective indicator, if you ask me. Now it's below 0, and it has been. It tested it. The 0 level often acts as support or resistance when tested from above or below, and that white line is still well below 0, telling me that at this point in time, at least by that trend indicator, the trend is still bearish until and unless we get a bullish cross with the 9 EMA above there. So let's see what happens. In trading, there's an old saying, price comes first and foremost, everything else is a distant second, and I do have to agree with that. So right now, we're simply back testing that channel. Let's see what happens. But again, you want to know where XLF is going? I think there are times, as I'm trying to illustrate here, that the ETF or the sector itself may be painting a false picture, because these are the leaders. These are the generals, these big mega banks. Wells Fargo, I pointed this out the other day, made an attempt at this downtrend line, failed. So far, a pretty strong rejection off that downtrend line. Maybe it's going to work its way down within this big sort of a contracting channel wedge pattern, these two lines, and eventually break out if this divergence remains intact, if the PPO signal line crosses back above zero. But right now, by my this trend indicator as well as price, this is a downtrend. A downtrend is simply defined as a security making a series of lower lows and lower highs, and that is exactly what we have here in Wells Fargo, a downtrend. So that's that. All right, couple more, because again, this is the financials. These are the financials when you add in these big banks. Bank America, it looks like a bullish falling wedge, so I'm sure that has the bulls, fired up. But the trend indicator is still bearish. Failed breakout. You can see a pretty nice, well-defined downtrend line. Look at all these reactions so far. We broke out, but as I said, that was a unconvincing breakout, lackluster, very non-convincing. It was an impulsive price action followed by a red candle, and now we're clearly back down below there. So that's a failed breakout in Bank of America. Citigroup, I mentioned this, a rising wedge, what I call an overshoot. We overshot the wedge, and now we're coming back down within it. These all have a little more work to do. Here's USB, failed breakout. This looks like that XLF trading range. Again, broke out, and we failed it so far. So what I'm seeing right now is what I was expecting, and the further the banks drop from here, the more it confirms what I was saying, that we've had a failed breakout in the financials, especially the leading financial stocks. There's Goldman, failed breakout. You can see it there if you look closely. Morgan Stanley, failed breakout, etc. Okay, so again, you can look at it the way you want. Confirmation bias, or let's call it lack of really drilling down into the components. If you're only trading XLF in a vacuum, sure, right now you have a breakout and a back test. I look further, I see the leading stocks, and again, I went over that before. The weighting of those components make up the bulk of the returns of XLF. All right, let's continue on. Okay, the next chart that I covered 5 weeks ago was XLV, which is the healthcare sector. And I'm using all the spiders except for the last one, and that's because they are owned by S&P. So I'm assuming that the XLV will be almost identical, or very close to the makeup of the S&P 500, because again, these are the S&P 500 healthcare sectors. So we have healthcare at 14%. And you can see back 5 weeks ago, I said any new high soon will be yet another divergent high. I showed a little scenario of us popping up. You can see my line giving it a little, I expected a breakout to new highs in XLV. That's why I have this line upsloping. That's why it wasn't connected there. And then I had it reversing. Coming in, hitting this trend line, another bounce, and then a breakdown of this trend line. I also showed it here with a little upside left on the PPO and the RSI. So let's fast forward to today. And that's exactly what's happened. There's your marginal new high. There's the divergent. It's divergence potential. We need to see the healthcare sector turn down soon. If so, we'll get a bearish crossover, which will put in a lower high on the PPO as well as the RSI, and see prices confirmed. So again, from where I was 5 weeks ago, if you go back to that post, you'll see I was looking for a little more upside in the markets. Fewer things are more bearish than these new breakouts to new highs that fail. And again, it's not just what's in the indicators. There's so many variables and factors I'm looking at now. And again, if I'm wrong, and this market's going a lot higher, then you want to see these divergences taken out. You want to see the PPO come up through there, take out the previous high. You want to see impulsive buying, maybe a back test. That would be a bullish case too. We come back in, like I mentioned, make a successful back test of this breakout to new highs, work off the overbought conditions, and then power up. That's your bullish case. Right now I don't see it, but I'm open to anything, so we'll watch and see what happens, how a lot of these sectors and indexes act as they come in and backtest these breakouts. All right, so next this is XLY. As you can see here, same thing on the arrows. I had a little more upside drawn before a pullback, and we were backtesting that rising wedge at the time. But either way, this is a price channel here. And there's your divergence, still needing to be confirmed. Wasn't confirmed at the time. By the way, that's a 12.5% weighting. Now let's look at what's happened in the last 5 weeks. XLY. And it's still significant enough to make an impact on the index. We went up. Still made another divergent high, but this divergence is now steepening. You can see that it's now confirmed. We have a confirmed divergent high. We have a lower high. We had a lower high here, another lower high. We call that double negative divergence. You can see it as well in the RSI. And this is the magic number right here, or the magic level, I should say. This is a pretty well-defined uptrend line. 1, 2, 3, almost 4, 5 reactions. This is an ascending price channel. So if XLY breaks that price channel, you can see the targets I have down here. I expect reactions more than likely at each of these lines, and this would probably be the final pullback target if things get really ugly. XLI, these are the industrials. So within the S&P 500, you have about a 10% weighting in industrials. And plain and simply, it's hard to say where this one's going to go. We had a divergent high here. We've extended it a little bit, but as I said, this is the important thing, this yellow line. Sell signal to come on a break below that yellow line, which it's getting a little long now to be an ascending broadening wedge pattern. This is, if you take this yellow line and this yellow line here. But what I can say is it's a pretty well-defined uptrend line, so that's really all that matters. So here we are, another divergent high. If we turn back down soon, it will certainly be confirmed. And again, there's some work to be done. I mean, these things are way up there. So to really firm up a multi-week to a multi-month swing short on the market, when you need to see all these sectors go and take out these levels that I'm talking about. Right now, they're still at their highs. And, until proven otherwise, the trend is up in these guys. So just showing you things I'm watching. XLP, this is back on May 8th. This is a tricky one. We had a breakdown here. It looked legit, but what happened is we came back. It proved to be a whipsaw signal, so we snapped back up. It was a well-defined trend line, too. We had a divergent high at that point, negative divergences, but since then we've gone on. You can see we snapped back up within the wedge, fell back below it. We still have divergence, now even a much larger and really more clean separation. I like to see on divergences, I prefer to see clean separation like we have here. A peak here, a big drop down, and a peak with a lot of separation between. So that's really a big rising wedge. It was broken, came back in. We need to see this thing roll over. Now, for those of you that say, well, divergences don't work anymore, sometimes you have whipsaw signals. Nothing is 100% in trading. But here you can look back here. You can see these divergences. You had a small divergent high here, led to a correction. And what I've noted here, you note the magnitude of the divergent highs and the subsequent corrections kind of go hand in hand. So you had a small divergent high at this point right there, and a not so small, but a pretty small correction, relatively speaking. We had a really small divergent high here, little correction. Another divergent high there, little correction. Now, all of that led to this one large divergent high right here. Prices making higher highs with the PPO and the RSI making lower highs. And then we had a really big correction. That was a big drop in XLP. Now, the scope of this divergence is pretty significant. So if and when we reverse, I don't expect a little blip like this. I'm expecting probably a move down at least to that 54.25-ish area based on the divergences. Again, and if they are burned through, if this market has, turbo packs on it and it wants to power on up, it'll burn through these divergences and none of this matters. So again, we're not looking right now. We don't have sell signals yet on a lot of these sectors. In fact, quite a few of them are far from it. So just keep that in mind, but these are things that I'm watching for, and I do think they're going to come based on everything that I'm looking at in the charts. It's just going to take a little time, but I do think, you know, whereas in 5 weeks ago in that last thing I was looking for more upside, we got that additional upside in a lot of those sectors that I was looking for, including stocks like Apple. You know, a month ago I was calling for another high before a breakdown of that trend line. We got that. So I think that the upside at this point now is limited, but we'll see. XLE. Hopefully you guys are still here with me. Here's the energy sector. It used to make up, I recall years ago, a much bigger component of the S&P 500, but you know, as energy does pour, you know, energy stocks, you know, have had a bear market, as you guys know, for years now. So that's contracted the weighting. So, you know, back 5 weeks ago was about a 6.3 weighting. And here was my analysis on XLE. There is a extremely well-defined downtrend line, and we had potential divergence and low. So I mentioned here that, you know, this would be your next sell signal. Buy signal. Of all the sectors, this was the one I was the most bullish on. However, I wasn't bullish yet. I haven't added any trades personally or officially, and I mentioned the possibility of another thrust down. I really like this level here, and in recent days and even weeks in the trading room, I've made it clear that my expectation, especially the other day, we hit this level, was that we are going to have another thrust down in XLE. Again, if I'm wrong, we break out, make a convincing break above this downtrend line, then maybe not. Here's what's happened since then. We were down here. We had another thrust down. We rallied recently, and I made this very clear in the trading room. We hit that downtrend line, and my expectation is for another move down. So far, we're coming off that impulsively today. We're down 2%. Which, you know, wiped out over half the gains in the last couple of days. So, you know, going long this big green candle, and especially yesterday or the day before, in my book, is contrary to trading, because you're going long just below resistance, and not just resistance, a very well-defined downtrend line, a key resistance level. So if anything, you know, I know the nature in trading is when you see a huge big green candle and prices are strong and rallying and they're beat down like XLE, is to go long. But you know, why go long? Just what is that? 2% below a major resistance level? Why not wait? Because if and when this level breaks, you know, my minimum target is going to be up here at about 71.62, which, you know, from where we're at today, that's about 9%. So again, if you want to know my preferred scenario, and I made this clear in the trading room back a month ago, I was, well, we could break out, but we may go down once more. I'm still favoring another move down, one last move. It'll take out the previous lows, probably wash out a lot of weak hands. We may even overshoot that level a bit. At that point, if the intraday charts confirm, if the charts of crude oil confirm and everything else, this is the one sector I might be looking to go long on. And we'll have to see what the market's doing as well. Because here's the thing. If the broad market starts selling off, you know, almost everything gets dragged down in a broad market sell-off, even good sectors. So I'm not going to tell you with certainty I'm jumping in yet, but I can tell you I'm holding off, and I'll wait and see how the energy stocks look when they get down around that $64 level. We'll just watch it from there. Okay, we're getting down the line here. These aren't as significant, but then again, you know, there's all types of traders and investors that follow the site. Utility stocks are defensive stocks. Typically during a economic downturn or stock market correction, they tend to do well because those are your utility companies. I live down here in Florida. It's big thunderstorm going on as I do this. You might hear the lightning. You know, so Florida and Power Light's a utility, and the last thing you do when things get tough is you stop paying your power bill. So they tend to shine during economic downtrends. Now, what's weird is this has just been all ships have been lifted in this rising tide lately, and we've seen a bid to the utility stocks. Now, is that the institutions moving into flight to safety, expecting a downturn? Normally you wouldn't see tech and all these high beta risk on sectors, high growth sectors, you know, screaming to all-time highs with utilities going along with it. But either way, A chart's a chart. So this was my analysis 5 weeks ago. We had a divergent high, but as you can see from my preferred scenario, outline scenario, I was leaning for one more thrust higher to pop out to new highs. I love to see previous highs taken out because on face value it's bullish, but if the charts tell me it won't be, so you can see this dotted line, that means that I was expecting, prices to make that new high with the yellow line there, the indicators, and that would then put in, remember I said I like separation in the MACD from the previous points, from right here to here, and that's what we have. Well, let's take a look at the chart and I'll show you. So that's what's happened. Now we have clean separation, we have clean divergence. We just made a bearish crossover. We put in that new high. So this may prove, it at least sets the stage. Nothing's guaranteed. So far, oops, wrong color. So far, we've actually just simply came in, made a back test. This is really, technical analysis has been working well lately in a lot of sectors. You see there's that divergent high, the new high I was calling for, the negative divergence. We pulled back, but we back tested both the breakout level, which is the previous reaction high, as well as that uptrend line I had drawn. We had a little false breakdown there, whipsaw signal, but that trend line is still valid. There's a lot of touches there, and another touch most recently. So right now, here's what you want to watch on the utility stocks. Again, they're low beta. I usually don't trade them. Because there's not a lot of meat on the bone. They don't move a lot day to day. But you can catch a trend, and if you're an investor looking to position into those, or you're already long, watch for a break of these intersecting support levels. The trend line will come in first, then below that you have the horizontal line, which was that previous reaction high, and then below that you have this trading range down here. So the top of that trading range could and should act as support on a pullback, and if it goes, then the next support is the bottom of that trading range. You can see the levels there, around 51 at the bottom of the range, 52 and change at the top of the range. All right. Okay, let's just breeze through these last three to wrap this video up. Since the weighting's so low, these are the REITs down, coming in around a little under 3%. The spiders, I was using the spiders because those are S&P on all the other sector ETFs. However, they have one called, I forget the TJU, forget the ticker right now. Apologize for that. But I prefer the chart of iWire because it's been around a lot longer. It was, I believe, the first REIT ETF to the market, and it sees a lot more liquidity, and it's a good indication of the real estate sector. Same story. I was awaiting a break and still am. This yellow uptrend line, we tagged it, bounced back then, and fast forward today, we rallied back up, put in yet another divergent high. So the REITs are, well, they're fine right now technically. So if you're trading the REITs, that's also horizontal resistance right there. They are at resistance with a potential, not confirmed. You see how the PPO is still pointing up, so is the RSI. So I'm neutral on these. I wouldn't go long here because we're just below resistance. If they break out and these divergences are burned through, maybe. But in the coming weeks to months, watch for a break of that yellow trend line because that would be bearish. Okay, this is XLB, Basic Materials. That accounts for also about 3%, a little under 3% of the S&P 500. And here's your levels. You have a support level here. This is a pretty well-defined support level. A lot of reactions at T1 level. Again, this is the May 8th chart. The date's stamped up top too, by the way. And those are the targets. We need to break that level. We had a divergent high back then. Fast forward to today. We bounced. We've held that support so far. And put in another divergent high, and until unless this level breaks. If it does, now we have a lot of reactions there. You can see reactions from below, reactions from above. That is a significant level. But until unless that's taken out, the trend is bullish. So just keep an eye on it. You could probably, if you took a 60-minute chart, if you're trading XLB or the basic materials, you could put this uptrend line here, and it'll probably show better on a 60-minute chart. Next one up, and the last one is XTL. Let's just zoom back to the other chart on May 8th. XTL, breakdown and back test. There's just a significant support zone right here. And we've been trading along it since we broke down from this rising channel. PPO was bearish. You can see the targets. Where are we today? XTL. We're still holding that support zone. That is a critical support zone now. Look at all the reactions from below and reactions from above and a reaction from below. So far we have the potential for a double top. We failed at the previous highs, so watch for that. Even if we pop above it, if we fail back, come back down, that would be bearish. So those are your levels. You know, the PPO did cross into bullish territory. There's still negative divergence. I don't know, mixed signals on the telecom. But I went through a lot of the components, and I'm not so hot about the telecom sector now. But either way, just watch that support zone. Watch a break for new highs. See if it's sustained and impulsive. And that's it, guys. So again, as you go through this, start with tech, financials, healthcare. Those are your big components of the market, of the S&P 500. And as we all know, tech has led this market up for many years. And this could simply be a case of sector rotation. We all know the tech stocks got ahead of themselves valuation-wise, momentum, you know, they're overbought. So maybe they need a breather and the rest of the market wants to catch up. So I've given you the levels that I'm watching, and all we can do is go from there. All right, this has been Randy Finney with the right side of the chart. Hope you enjoyed it.